Oh, Chris Pulver took a trade in our Discord.
Oh, really? Let me see.
Pulver alerts are now available in the A1 Trading Discord. If you want access to everything Chris Pulver is trading, click the link down below or click the link being dropped in the chat now to speak directly with a team member.
Hey everybody, happy Thursday. Trying to share my screen here. There we go. Let's get after it. Oh yeah, can you guys bring up my screen? Thank you. All right, hey, I'm doing an update on the Pulver alerts. I closed out all of my SPY calls this morning. Hopefully you did the same thing, paying attention. We have a couple trades that we're gonna pop around to. So here is the SPX this morning. I've got a little strangle running today. 58.55 looking pretty good, trying to go after a small take profit. And hopefully price just oscillates here. We had a nice gap up, filled the gap or close to it, very close to it. But the nice thing about today on the SPY, was that we went from a close yesterday around 582, and we also had a nice little positive drift up. So I was in, and I shared this in my Pulver alerts, I was in the 584 and the 585 and the 586 long calls. So I stacked up some long calls yesterday. I closed out a couple of them. So my 71-cent debit closed out today. So here are the results. The 585 long call, I paid 71 cents debit for. When we talked yesterday in session, it was trading for about 65 cents. Okay, today I closed for $2.47 debit or credit, sorry. So that's a really nice win. That's over $1.70, right? $1.76. So $1.76 profit per contract, and that is about a 246% win. Not bad. Not bad. And then the 584, the 584 and the 585 and the 586. I got in those trades for about $1.91 to $1.94. And it closed out today for anywhere between $4.90 and $5.26. That was my best close on the day. So credit and debit, and those wins added up being around 100 and I want to say 176%. So the net gain, what is that? $2 and change. I'll just take the math based on the lower one. So if I close out for $4.90, I paid $1.91. That's 156% gain. That's pretty good. So 156% gain. That would be 2.99 profit per contract. Okay, so I'm hoping that you saw the same thing I did. The strike price was what I was after, and so when we opened up there this morning, that was perfect. What was nice is pre-market, I went in and I removed all my limit orders. I had a limit order in at $3, $3, $3, $3 on this order, and it was actually trading above $5 when I started trading this morning. So good win on that one overall. I'm pretty happy with that. Very nice. Yep. Jay says close out the daily profit play for $50. Awesome sauce. My trade's looking pretty good. I'm going after a slightly bigger profit because I narrowed the width on it, but price is cooperating on the SPX this morning, which is nice. And that is, let me see where we're trading at right now. 85 cents. So I'm close to the take profit. This is going to hopefully this gets filled. We're trading at 80 cents mid. Let's go. Give me that 25%er. If I bump this up, I mean, you can trade in 5-cent increments on the SPX. So if I bump up to 85 cents, I could probably get filled on that. 85 cents. So if I go $1.10 minus 85 cents, I take 25% or 25 cents divided by $1.10. That'd be about a 22.7% profit. I mean, it's okay. I could take the profit right now, but I'm just going to let it sit there and hang out and try to give me that full 25%er. But overall, pretty good day. And, we hit a fresh all-time high today, and the market looks like, are we celebrating all-time highs when it actually pulled right back? Maybe. It doesn't matter. But retail sales, the numbers came in pretty solid this morning with the U.S. U.S. retail sales were pretty solid. The revisions were good. Unemployment claims weren't scary. So all good. Ken says morning daily profit play in at $3 credit out at $2.25 debit. Damn, Ken, you're going after a little bit bigger take profit, dude. Good stuff. Cool. Okay, so I'm updating. I'm going to do a little reply in this one. So can I reply to the reply? I think I can. SPY, long calls, all of them. Closing 584, 585, 586, long calls for profit at opening bell, which I know is past. But our price target of 585 was reached with this morning's gap, closing all for nice gain. So anywhere between 246% return on capital, 156% return on capital. And that deserves some dollars. Good. Okay, and we're right back to center, looking pretty good. Hopefully my trade here will be knocked out for about 80 cents in a little bit. I am showing some P&L to the downside today, and a lot of that is attributed to some China stocks. I'll go to the entire portfolio. I'm just going to do some reviews. So my P&L in the day, Baidu is down, TSM. So I'm down on TSM, but the trade is out to next week. Now, I realize that I could be totally wrong on TSM. This is behaving a lot like Micron did, but what I hopefully learned from Micron, and Tony, to answer your question, zero. I don't drink caffeine. So I am a soda water guy. I just have a lot of energy when it comes to trading. Okay, so TSM, I have this trade running. I need to see if price will revert and try to gap fill by next Friday. It's possible. There's no real risk to the trade. I mean, I'm going after. I've got about $8 risk on the trade for $12 credit. If price comes back into this yellow box, then I should be able to see some quick profit on this. So I'm looking to see if price will gap up and then start to fill the gap. If we come back and just, test the candle low, not only fill the gap or even attempt to fill the gap, then this trade is going to get profitable pretty quickly. So that $12 credit hopefully turns into like a $10 debit, $9 debit, $8 debit, and I'll look to manage that. So the learn from Micron is I went out another week, because Micron, I think the trade came out like Wednesday and I had it expiring on Friday, and literally Monday it was back into profit and it would have closed out for full profit at like 650. So I'm going out another week on TSM to see if this will actually pull back a little bit and try to fill this initial gap, because we did go beyond the expected move, like quite a bit actually. So this was from the close yesterday to the open today. That was an 8.43% move, and we pushed up even higher. And I mean, I had the thing sold at 207.50, which would have been $20 wide, and we were looking at like a $12 to $15 move. And it made from point to point. I mean, it opened up about 17 points. Yeah, about 17 points higher, and it's supposed to move like 12 to 15. So anyway, we'll see what happens. But that's TSM. That's out the next Friday. We also have Netflix, which comes out today after market, and we'll see what Netflix does. We're down to 693. Good Lord. Well, I'm hoping that this is an interesting sell-off before earnings. I don't know if this is a sign of things to come, but we'll see what it gives us. I do have 2 bull call spreads on Netflix. I took one yesterday. That's about $25 above the expected move, or above center price. That was around $700 yesterday. So we're going to have to see a big fat surprise to the upside if I'm going to get paid on this. So my risk on the trade, I took 2 bull call spreads. I have 90 cents on one and 83 cents on the other. So I'm all into the trade for $1.73 with a max profit of $5. So if I win, which means price just has to go back up to these highs, okay, if I win on the trade, then I walk away with $5. I paid $1.73. I make $3.27 for a risk that, I'm willing to stomach if I lose. But we'll see. But we've got to have a pretty big move to the upside on Netflix. If it drops, then I'm going to lose on the bull call spreads. But I also have this is a 1-1-1 trade. So I have a 600 by 595 and a 550. I'm willing to take shares of Netflix at 550, and I would take the shares technically. Trying to think here. Let me check on my Netflix trade. I wish there was a way I could search in my thread to find it. So let me actually 1 second here. I'm going to edit this one to put everybody on it. All of them. Okay. I'm going to search in the stocks section for my Discord. Let me search for Netflix. So we got Snapchat in there. Netflix. Okay. So I know when I took like MicroStrategy, Netflix, and a couple of other trades, I put in that 111 trade and then I added in the hedge to take off some of the risk. I'm still willing to own shares of Netflix if we have some big fat move to the downside. I'm just trying to find it. Disney, Lululemon, Micron, SPY, Microsoft, FXI, JD, Meta, Netflix. Here it is. Oh yeah, that trade's out for a while. That's a 12/20 expiration. So I collected 250 credit on that one, and then I can trap the profit. If I own the shares, I'll own the shares at $542, which would be a discount. Current price at 542. That discount would be, I would own Netflix shares around 22% lower. I'm okay owning shares of Netflix. Okay. Because the premiums are so high. Like if you were in the top strategy session I did this week on Tuesday, I think at 4 p.m., I talked about, Nick chimed in and talked about his trades on Tesla and how quick you can repair it. I think that's one thing I could do with Netflix. If I could take the shares, I can allocate the capital. I know it's expensive to have 100 shares of Netflix, but the premiums that I could keep over and over again for a 2 to 4 week window, I could probably lower my cost basis by $10, $15, $20 in a very short amount of time. So it should be an easy trade to repair if I own the shares. But hopefully what we're seeing here is just a pull back to the 50 and then a nice move with some momentum to the upside. And this just becomes a buy the dip. Now, Netflix has also hit the 100 period, hit the 100 period. So if we pull back here and have a gap fill, I might just put in a credit spread. I'll eat the bull call spread because that's small loss. But if we have a gap lower, I'll probably look to put in a credit spread and fill the gap and see if that is a profit trade for the next maybe 30 to 45 days. Okay. All right. So those trades are running right now. Keep an eye on those. And I do want to take a look at some of these China plays. So Alibaba is pulling back. We're still at that 38% level. If we go to Baidu, Baidu is just below the 618. This son of a gun. We're not getting the follow through that I like out of this China stuff. One thing, I don't know if the election is going to have anything to do with China. If there's risk appetite out there in the U.S. and it flows into China stocks, I don't know. If this comes all the way back down to where this thing started, I will be really annoyed. We'll see what happens. But JD is down to 38.98. I did buy some shares, and I'm looking to repair this. So I think my covered call at 43 is probably mostly profit. I can probably do a quick roll on this. So, and also my SPX trade's got to be close. I mean, come on, man. I got 5 cents more to go for that 25% profit. Let's go. Let me take a look at JD, and let's go. Here we go. So I've got 500 shares. They're covered at 43 cents or $43. If I close my covered call, this is perfect. This is totally worth rolling because tomorrow I can only get another 5 cents of profit on this. I might as well take the extra time and roll this trade. And I know my break even's like 41.63. So let me go to my tracker here. Let's go to JD. Come on. There we go. So I own the shares at 41.63. So I have it in this account, and I did the roll there. I have it in. I don't think I have it in this account. I'll double check. I know I have it in this account. Yes, and I have it in this account. Yes. Okay. So I know I have it in 3 accounts. Let me double check here. So JD has 500 shares in 3 accounts. Those are income plays. Got it. All right. So now, little management. This is a good lesson for rolling. Now I'm going to take my $43 covered call, which I collected $1.73 on, and it's now trading for 5 cents. It's 97.7% profit, which means all of that decay has come to me. So it's now an income trade, and I've collected $1.70, about $1.68 of profit. Now I'm hoping I can close it out for 5 cents and I can roll it into another week. So the 18th, I'm going to roll it out to the 25th. I'm going to see what I can get for it. So if I roll this, go back to this trade, sometimes I have to do it twice. So I'm going to roll this out. Okay, so now I'm closing the $43 that expires tomorrow, and I'm going to roll it out. Ooh, that's not great. So if I roll it out to 43, so I know my break even is 41.63. If I roll it down, if I roll it to break even, which gets me a 41.50, let me do the math on this. So if I go 41.63 and I can roll this out for 53 cents, that puts, oh, dang it, 41.63 minus a roll of 53 cents. I can have a break even of 41.10 if I get it called away at 41.50. So I can make $200 credit and lower the cost basis. If I go up a strike, and I would get, let's do this. If I rolled it up to 42, so let's try 41.63 minus 44 cents, puts me at 41.19. Get it called away at 42, make 81 cents a share. I make $405. I'm good with that. So I'm going to roll this out a week and down a strike. And if it gets called away where we pop up here to 42 bucks, I get $400 of income. If I go out one more week, I don't think I'm going to get a ton more credit if I go out one more week, but let's find out. Are there earnings? Earnings on November, we're good. So I don't have to go to earnings yet. Oops, so go to the 25th. If I roll this out another week, that gets me into November now. November 1st is pre-election. I go out a couple weeks here. If it gets called away at this one, I'm kind of willing to go down to 41.50. Let me do the math here. Is everyone understanding this? If not, I can spend a little time. I'll talk about, I bought the shares, I covered it, I lowered my cost basis. I'm rolling my call to lower my cost basis. I'm trying to figure out where I'm going to get the stock price called away. So if I roll it to a 41.50, my break even is 41.63. I roll this out for 95 cents credit. That brings me down to that 40.68, and I get it called away for 41.50 times. So I can get 410 bucks, and I can roll it down to 41.50. That's only a couple dollars below current price. It's out a couple of weeks. That's not bad. Not bad. If I go up another 50 cents, that should be another $210. So that would be 41.63 minus 81 cents credit. Get it called away at $42. I make $590. So the idea is, number one, repair the stock. Number two, just track the break even as low as I possibly can. I still think JD is a worthy hold, at least in the near term, for the next like 2 to 3 months. So I will probably end up sacrificing some of the upside if it pops back up to those recent highs at $46 or $47. I will be covered at 42 or 41.50. I'm going to get it called away, but it's more important to me that if this becomes an income trade for $400 and it goes up, okay, fine. I'm sacrificing the upside. I'm capping my upside. But in the event that this goes down, it is easy for me to keep moving lower, keep moving lower, keep moving lower, and get the stock called away. That's the most important thing for me. And I could see this area, you've got this wide open gap in here, right? Wide open gap in here. That if we end up pulling back into this like low 30 zone, I got to be able to lower my cost basis with it. So that's probably what I'm going to do. All right, I'll give this a chance. I'll go 42. Let's see. That gives me $400. That gives me $600, right? $590 if it gets called away at $42 by November 1st. Okay. If I wanted to get close to the money, let me do some crazy math here. If I take this down to like a $40, let me see what they lower the cost basis to. So 41.63 minus $1.43. So it's not enough. I don't get a break even. That would essentially be like, I just want to get out of the trade for break even. I could lose 20 cents on it. That's no big deal, but I'm going to try to make a few bucks. So I'm going to go out to the $42, roll my strikes down another dollar, get 82 cents on this one. And hopefully this gives me a break even. So 41.63 minus, if I get filled for 83 cents, I'm going to try to sneak a couple more. 40.80, get it called away at 42, $1.20. So that's $600. All right, I'm going to go for this one. So I'm lowering my strike to 42. I'm going out 2 weeks, 83 cents of credit. I'm going to try to get 85. See if this will take. Didn't take it 85. Trying to take it 84. Trying to take it 83. Okay, the bid is 79, filled at 82 cents. Okay, so that trade, I'm going to go similar order for this account. Actually, just to make sure I do, I'm just going to do it manually. So this account, there's my 43. I'm going to roll this now. Quick roll out to the first, down to 42, try to grab 83 cents. 82 cents. Survey says, you dirty dog. 82 should be filled. Come on. 81. Filled at 81. Okay, and then this last account for this trade, there's my covered call. Do a quick roll. Expiration the first, roll it down to 42. Try to get 83 cents again. And then work it down until I get filled, hopefully by 82 or 81. And it looks like 81 is going to fill. Filled. Okay, got filled at 82 cents. And this one got filled at 81 cents. All right, so I'm going to update my tracker. Does anybody have shares with me in this? Maybe you bought 100 shares. If you bought, I bought 500 shares. Either way, the numbers are going to work similar. You just track your buy price minus your covered call, and then I rolled it. So then the next credit, and then I rolled it again. So the next credit. So here's what it looks like on my tracker. So I rolled out. So I'm going here. I can go ahead and delete this $1.37 per share. And I rolled to 11/1 expiration, $42 covered call for 81 cents credit. What just happened there? That was weird. 81 cents credit. And I collected 81, 82, and 82, but I'm just going to go to the low end. So 82, 81. So that puts my break even, should be 40 and change here. So 41.63 minus 0.81 puts my new break even at 40.82. So if called away, that's $1.18 per share. So that way I know if it gets called away at 42, I make 118 a share, 118 a share, and I've got 500 shares. I make $590. Okay. So I'm curious how many traders I have that are in the JD trade with me, and if you're able to track it. So can you explain what rolling and what the? Yep. So this is just a great live example to share. So right now, let me update this. So I'm going to get rid of all this crap here. So bought the share. Okay, so this is a good example here. So as I walk through this, let's pay attention here, okay? So I bought the shares at 43.90, okay? Against that, I sell a $44 covered call for 60 cents credit. That's the first part of this journey. Is I bought the shares for 43.90, okay? And do the math on that. So I buy shares at 43.90, and I buy, let's say you buy 500 shares like I did, or let's just make it easier, buy 100 shares. So you can control an options contract. So I buy 100 shares at 43.90. If I cover those 100 shares with a one contract sell call, that covers all 100 shares that I buy. So I covered them for 60 cents. I bought them at 43.90. I covered them at $44, lowers my cost basis by 60 cents. So that brings me down to a break even of 43.30. So if it gets called away at $44, I make 70 cents per share. So if I'm in 100 shares, I make $70. If I'm in 500 shares, I make $350. Everybody following that? Okay, so I sold the $44 cover call for 60 cents credit. Then I rolled. Okay, I rolled to 10/18 expiration, $43 covered call for $1.67 credit, which puts my break even. So this would be, let's go break even here. Break even would be 43.30. because I took off 60 cents. And then my 43.30, which is my break even here. Okay, so after the first covered call, my shares are break even at 43.30, 43.30. And the reason I rolled this again is because I could close out this covered call instead of going for the entire expiration and trying to grab the full 60 cents. What I did instead is I closed it out for like 5 cents. And I collected most of that premium, and I'm just rolling it because it's not worth hanging on to it for another 1 or 2 days to get 5 cents when I can just go out and grab $1.67 over the next week. So that's what I did. All right. So my break even at 43.30, and I took that trade for $1.67, which brings me down to 41.63. So now the break even is 41.63. And then I rolled to the 11.1. This is what I just did today. Expiration $42 covered call for 81 cents credit. And that gives me another break even. So my 41.63 is now 81 cents cheaper. So now my break even is 40.82. Okay. So break even 40.82. If it gets called away at $42, which is my covered call, then that's the profit that I can keep. So it gets called away at 42. I keep $1.18 a share. If it's 100 shares, I make $118. If it's 500 shares like I have, it's $590. And I will keep doing this until this is profitable. Okay. Does that make sense? Now, I realize that if this stock, and this is where everyone like, oh, that makes a lot of sense. That's perfect. I should do that too. And then price does this. Boom. It goes right back up to the highs. And it's like, well, I got it covered at $42 and I'm missing out on all this profit. Well, if this stock goes down to $27.50, I have to aggressively lower my cost basis week after week after week, which I'll do that. I'm going to make money on this trade. Okay. So if I lose a little bit to the upside, it's okay. I'm still going to turn hopefully $500 or $600. I'd like to somehow time it well enough where, price does turn up and I can roll it again and maybe grab an extra 30 to 40, 50 cents and maybe turn it into $1,000 profit. So I will finesse this. If I get it called away at 42 right now, it's going to make me, $590. If I get a chance to roll it again, maybe I can time it where I can turn it into $600, $700, $800, But eventually I will turn this trade into profit and it's going to be fine. But I'm in this trade. Okay. So that's a little lesson on, I talked about this a little bit with Nick on Tuesday for that top strategy session, which I think is floating around in either the Discord or it's in the A1 Trading YouTube channel. So I would check that session out. It was an hour and 40 minutes. I thought it was great. I think Chandler trimmed it up so it was nice and neat. But I think it's a great session. I talk about just trading the stock market in general as an investor, trading the markets like Forex and crypto and futures because it's price action based. And then we get into some simple option stuff too. Okay. Yep. So if you want to get that, there you go. So send a direct message to the team and they can hook you up with that post. Right. Okay, cool. So that's a little lesson there on JD. And I'll keep tabs on this one. I am going to watch it, but this is out to November 1st. So there's really nothing to do now. If price goes up, here's one thing I will do. If price pops back above, I may look at another roll on this one. But the issue now is that if I want to roll it, I probably got to roll it out farther in time. And that's not necessarily a bad thing. But in the back of my mind, I'm wondering if Trump wins November 5th or 6th, whenever it is. If Trump wins, I do wonder if China stocks are going to be like, oh, crap, tariffs are coming. I don't know. That's just in the back of my head. I think there's still stimulus and the global economy is going to lift off and we still have, highs to be made for the year if everything just stays afloat. Basically, the market is waiting for this. Okay, what is the market waiting for? Okay, we have elevated VIX, which is your volatility and your fear gauge. It's elevated and it stayed very elevated since August 5th. As we go into the election, we have election jitters, which doesn't mean it's going to be like, oh, it's a big deal, but it's like the market just wants to get it out of the way. Like whoever president is, market's going to digest it and run with it, good, bad, and different. We don't know if it's going to be up or down for either candidate. It doesn't really matter. But once it's done, like once the market can say, okay, election jitters, it's over. It's now a reality. Then we have the Fed. What else is in here? So you got the Fed. Fed November 7th, 25 basis points cut. Okay, once these things are done, then it gives the market the clarity to say like, okay, we can move on and do something else. And I think we're in a pretty good environment right now. I know things seem a little top heavy, but as I mentioned earlier, there's so much protection out there. So many puts are being bought. Like if you look at, have you seen the price skew in the markets? This is pretty wild. I see this every morning in my daily profit play. By the way, this thing hasn't closed yet. This price has been cooperative all morning. I think it's just I'm going after the slightly bigger take profit. It's just sticking around that 85 to 90 cent zone. I mean, come on, would you? So 25%. Let me see if I get if I pull 85, so 110 minus 85. 110 minus 85 is 25 cents divided by 110. That's a 20. Yeah, I'm just going to go after that. I'm just going to take the 22. So I'm going to go change this to my 80-cent debit. Whatever, just leave it. I mean, I'm just looking at like I'm 5 or 6 cents away. Hopefully it's fine. Anyway, this will probably hit by the next 12 minutes or so. I hope it does. What was I talking about? Oh, I was going to say the put skew. If I go to check this out. If I go to the SPY for tomorrow, okay, take a look at this. What is running right now? These trades are done, right? Oh, that's my butterfly. Okay. If I go to the SPY, I want you to see the difference between if I were to do some premium collection here. So this is the expected move for the SPY by tomorrow. If I sell, let's just look at the deltas here. If I sell a, let's just go like 11 delta. If I sell an 11 delta call for tomorrow, I can get 25 cents. Okay, so I get 25 cents. If I sell an 11 delta put, I get 29 cents. Now that might not seem like a lot, but getting 4 to 5 cents extra, if you do this on the SPX, okay, the SPX, you're getting almost 40 cents difference, like 40 to 50 cents difference. So that price skew is really substantial. And what it's showing us, it has nothing to do with direction, right? This doesn't mean like, oh, the puts are more expensive, so the market's going to go down. It doesn't mean that at all. It just means that it is a higher premium to buy protection right now. And that's why for months and months and months in the summertime, everyone was talking about, I'm saying smart people, we're talking about how cheap it is to buy puts or how cheap it is to buy insurance. Okay. And it paid off with that heavy drop, early August. I mean, really it was August 1st, 2nd, 5th. You needed all the insurance in the world because that was a crazy vol event. After that, you haven't needed anything. April was a little bit of a discount, a little bit of a pullback, but August was a very disruptive vol event. But other than that, it's just and I get it. Like I've been buying insurance and I've been buying puts and I've been trading butterflies and all this other fancy stuff that's like, if it goes down, I want to be hedged. But I also wonder, the contrarian in me is wondering, it's like, well, if everybody is buying puts and everybody's overpaying for these puts, that might be the perfect ingredient for the market to be like, that money's worthless. You're wasting all that money. And then when they stop buying it and they just start going back into all-time highs, they get complacent again. And that's when the market's like, okay, now we're going to go. So I just wouldn't be surprised if the market doesn't really want to drop aggressively because everybody's out there with these long puts and everyone's out there with the higher premium puts to protect their portfolio. It's not a bad thing, right? It's a necessary evil, but it wouldn't surprise me if this market just doesn't really do much of anything as far as pullbacks. We have continued to just chop and make these all-time highs. We do have some jitters here, but look, let me ask you a couple of levels here. If this market pulled back right here, how many of you would buy the dip right there? Right there. And I'm not saying like go in the SPY, but it's like if you buy it there, could that bounce? Yep. How about here? How about here? Okay. Certainly here. I don't know if we're going to have an 8 to 10% correction before the election. I doubt it. We could. Could we have a correction because of the election? Because of the combo of the election and the Fed and non-farm payroll? There's so much volatility that first week of November. It's going to be pretty crazy, right? Now, I would say at that time, it's probably worth some type of protection just to make sure. And nobody knows the timing. It could happen before the election. It could happen weeks and weeks after the election. Who knows? But I wouldn't mind having some protection as we go into the election for that reason. But I look at all these levels like this is still fairly healthy. I think the market broadly is still really well supported. A dip is a dip, a pullback's a pullback. I don't see there being any major technical damage or structural damage unless we take out this August 5th low, right? So any of these areas that I noted here, I would be interested in buying dips or at least putting on some bull calls or bull put spreads on all these levels and just having some exposure and seeing if we get to higher highs for the year. Okay, Nasdaq, same thing. If I go Nasdaq, same thing. Nasdaq, we're not quite to all-time highs, but pretty well supported. We have support, we have support, we have support. 50 and 100, we dip into this area and then we go higher. Okay, pull back in this area. We don't take out the low. Is it able to get back to these highs? I also wouldn't be surprised if we just keep grinding and grinding and grinding and grinding and grinding and we get to these highs and then there's a little bit more of a pullback or stall. And then we see if post-election, we can actually go into higher highs. I'm going to be in a webinar today at 1 o'clock that is talking about the last time we had this rate cut by the Fed while the market had a sell-off was 1998. 1998 to 1999 into 2000, the tech market ripped like crazy. The stock market itself ripped like crazy. It would be an interesting repeat if we did that. If we truly have like another 1 or 2 years of this like late cycle extension or this like cycle reset where the market still has room to run and margins are still looking good, earnings season comes out really positive consensus wise, so we could still have more upside. Don't fight this stuff. I don't think it's worth it. Okay, the Dow gapped up again, all-time highs. Okay, cool. I mean, the Dow actually looks like it's performing better than the others. When really it's not 20+% for the year, but price action wise, like it's got some space. We are creating some space between the 200 EMA right now. We haven't hit it in a while. Yeah, we haven't hit this in a minute. So this is last time we tested it was there. We are now 240 bars. It's not crazy overextended, but it's overextended enough where maybe a pull back to this level, I'd be looking for credit spreads. Pull back to this level, looking for credit spreads. A pullback below the 50 and the 100, then back above it. That'd be a great spot for credit spread or bull call spreads. There's all sorts of ways to get the job done. All sorts of strategies we can trade to make some money there. I just want to see if we get the pullback to offer up the dip. Okay, the Russell, another slightly, actually, yesterday's high was better. The Russell did great yesterday compared to the other markets. It was like up, 1 point some percent versus the others being down, right? The Russell was up yesterday while the market was down, which is kind of nice to see. Can I explain why gold went up today? Because the current price is higher than the open? Just kidding. I don't know. I mean, gold's all-time highs. Frank, gold's running away from you. No, I don't know. I mean, gold just maintains a bid. It's been one of the better assets for the entire year. It's been one of the better bullish markets for the year. It's a healthy bull market. I still don't look at gold and think like, oh my gosh, I'm going to sell this. I don't want to. Right? I mean, if this is up and sideways, up again, look, this can stretch higher and higher and higher. If I'm going to start looking to protect 25% take profit hit, finally, that took a little longer than I wanted to, but still, I'm going to update this over here. Trade update, daily profit play update, SPX. Trade 1, $1.10 credit and 80 cents debit. Okay, so I'm good with that trade there. Went after larger profit target. Took longer to hit, obviously. Okay, good stuff. Gold has been in a healthy market. It's looked bullish all year from pushes to pauses, pushes and melt ups. I'm looking at if gold gets a little capitulation move where it starts to get really aggressive, it almost looks exponential. Then I'm going to start looking at, okay, I think it's time to start trailing my stop losses and making sure that, any type of nasty correction, I'm not going to lose out on this upside potential, and I'm not going to give a lot back if the market tops out. But if gold just keeps doing this, if gold is going up a little bit and then pausing, and then up a little bit more and pausing, and up a little bit more and pausing, that's fine, because it just shows that there's healthy accumulation and there's pushing higher. That's fine. But if it gets exponential, then I'm looking at, okay, it might be a little toppy. But look, we've got some good volume coming in. We're breaking out. It's fine. I mean, I don't know why gold's going up other than we've got interest rates being cut. The ECB cut rates today by 25 basis points. The Fed's going to cut in November. Yeah, we'll find out. So I did see something a little disturbing today about the 30-year mortgage. Somebody's talking about mortgages being down to about 5.75 by the end of next year. And I'm like, mother effers. The 30-year right now, or the 30-year mortgage is 6.32. It is extremely sticky right now, and I'm not loving this. I'm hoping that with 2 more cuts by the end of the year, this at least goes back down towards like 6%. I'd like to see this settle in. I mean, my gosh, if the Fed is at like 4.25, if the Fed's at 4.25, obviously banks are going to keep their freaking margins, but come on, man, you can't go 4.25 and have this thing at 6.3. It's got to give a little bit. I'm hoping. I'm saying that because I'm buying a house next year, but I'm trying to close in April. I'm trying to get the rates as low as possible. I'll probably have to fork over a little cash to lower the percentage. I mean, if I buy down by 50 basis points, I'll see what that gets me, maybe low 5s, which I'm not in love with, but we'll figure it out. All right. So yeah, Santiago, I mean, it's just, I think gold is just a great market to be staying bid. I want to see if silver is performing the same today as well. Silver is up about the same, 0.74% on silver. So not quite taking out these recent highs, but I'd love to see it take out those highs and make some momentum shifts into the high 35s, almost $36 for my first target. I'm still trying to hold on to silver. I'll probably end up taking profit here and then reestablishing. I've got a lot of profits running on silver. I'm up like close to 40 grand right now. So if I go between my silver position, so I've got SLV and my silver futures. So I've got that's about $9,000 right there. So in silver futures, about $9,000. And then in SLV, around $39,000. So I'm up like 48 grand on silver. If we get a push up, let me just do the math here. We get up another, this measure move at 35. Let's see what that percentage is. If I go up another 12%, so if I go 40, let's go 48K in profit plus another 12%, I'd be up to 53, almost $54,000. Probably going to take some profit there just to protect. I can always get back in. I can always stay in. I can always trap, whatever. I just think I'm going to hold out to that level. And Bitcoin still has some room to run too. We are getting some resistance at Bitcoin. This is the level I've been watching. Heavy resistance right up here at the top. I don't know. In a way, it's like if Bitcoin breaks out, that's fine. I have established some new positions on BITO and IBIT, FBTC. If Bitcoin pulls back, this is still a really good spot to look for buying. We're coming right back into the 200. Look at how these EMAs are clustered together. That could offer some really nice dynamic support. Okay. So if we pull back towards like 60,000, that could be a good buy zone, provided we get like a nice little indecision candle, then go higher. But what we're really, I think for all the bulls out there, we're just patiently waiting to see, do we break into some fresh highs? If we break and we pause, that'd be a nice little accumulation zone. And then we see if we go higher and higher and we break all-time highs, and then we're off and running. And this momentum really kicks up, and this is a swing, all this for accumulation and then another measured move. And that is why I had this big yellow box in the background, because I've measured symmetry all the way to 107, almost 108. And that would be a wave 3. So if this is wave 1, this is a pullback and consolidation zone for wave 2. Wave 3 is measured all the way up here. So 108. And I'd be looking to take some profit there or let it go to wave 5. If it pushes wave 3, pauses here, pushes wave 5, wherever this pulls back, like measure the symmetry. Maybe we're in the 40s, 150s. So Bitcoin could be a fun ride to take. If Ethereum would do the same thing, it's got to get above 28.15 for me. MicroStrategy has pulled back from those recent highs. Pretty choppy on this one. I'm not doing anything with MicroStrategy outside of sitting down here with these ratio spreads and these 111s for profit, just income trades. I would buy shares if we come back into like 160 or lower, but probably not. I'd rather just trade the income because the IV is pretty high. Copper, I'm staying out of copper for right now. If China is not showing any sign of upside, copper is probably going to drop. Copper is big in China, and I think copper buyers for a while have thought, I mean, this almost looks like China, right? China went up, China went down, copper went up, copper went down. So if China turns the corner again, then I'd say copper has a chance to go bullish. Otherwise, I'm going to stay out of it for right now. Okay, Japanese yen, nothing there. Nikkei has been asleep at the wheel for the last couple of, I mean, almost since when? Since like mid-September. We haven't seen much in the Nikkei. FXY, this is Japanese yen. That's out to 2026. Oh, let's talk uranium. Everyone's probably reading some headlines about uranium. There's big partnerships going on in energy and nuclear energy. I'm in URA. I own it. This one's up a decent chunk. So my play on URA, I can just show you right here. Let's go to URA. So right now I'm up about just shy of $13,000. I have some shares. I have a lot of puts. I've got a call out to 2026. I've got a $20 call and I've got a $22 call. I'm going out longer term. Okay. Because if this one is going to run, this is another one that I've measured. Let me get rid of my moving averages here. So URA, if we range on this one, I'm totally fine scooping up some more in the $20 zone. Okay. But if this is breakout consolidation, what I'm hoping for is this isn't just a sideways area. If this is sideways, okay, and if this is a fake out, we come back down, okay, fine. This is why I'm out to 2026. What I'm kind of hoping for is that this wedge has broken out, forming a pullback again, getting to higher highs. If we break this momentum high, then this is looking good for some open space. And so I'm targeting like the mid 40s for a wave 3. Right? It's pretty straightforward. If I draw a box here from this low to high right there, and then pace some symmetry, puts me up around $42. Okay. Pace that again. Let's say that we pull back to past resistance becoming support, and that put me up to around 56. So I've got two targets on URA, $42 and $56. And so I'm long a call to kind of leverage my gain, but I'm also long the shares to let them ride and take some profit at my my destination. So I do like this trade. Yeah, I'm long uranium, and there's other ways to trade it. But I'm not interested in like the miners. I'm just interested in the spot price and something that reflects, if uranium is going higher, and there's, what I keep reading about it, there's supply issues. And so if everyone's making this migration into nuclear energy and cleaning up nuclear energy, then the supply is very, very limited and there's a lot of scarcity, and that could certainly drive up prices. So that's a play, but it's been pretty good for a kind of diversified. It's kind of a non-correlated thing, not correlated to the S&P, which is nice. Right. But it's higher beta. It's going to be a little bit more volatile, but I'll keep that there for just some measure moves. All right. Anything else for me today? I don't know if we have another guest on. Seems like I haven't been pulled off yet. So let's see here.
Hey, Chris, hey. I got bad news.
Cool. No worries, man. Right. I did my stuff. All right. Thanks, Chandler.
Yep. Guys, I've been putting Chris's YouTube in the chat. Make sure to go subscribe to him. He's on every single day. Yep. He's in the Discord at the Pulver alerts. So if you want to purchase that as well, we have a way to contact someone on the sales team, and they can get you hooked up with something. So Chris, thanks for coming on.
Of course. All right. See you guys tomorrow. Thanks.
All right. See you.
Bye.
All right. And guys, we got Nick Phillips next. So hang in, and we're going to run this quick break, and we'll be right back.
If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Hello. Welcome to the 11 o'clock segment of the A1 Trading Show. My name is Nick Phillips. I am a Forex futures trader for those of you that don't know me. And yeah, let's get into it. So this week we have had sort of a, I don't want to say it's been quiet. There's been a little bit of movement, but of the data that we have been trading, which has included some pound data, some Australian data, New Zealand dollar data, and CAD data. This is everything we've traded this week. GBP employment change figures, CAD CPI, NZD CPI, pound CPI, the Australian dollar employment change late last night, and the ECB meeting this morning. Of all of those, the beginning of the week, the data that came out at the beginning of the week was rather mixed. We had no trades on the employment change information out of the pound. We had no trades out of the CPI out of Canada. We had with NZD CPI, the data was as expected, but it also dropped during the rollover hour for the markets. So that was a non-tradable event. The only two events that gave us real solid opportunities this week was the pound CPI, which gave a slight downside surprise, and we took some sells on that. I'll go over that in a second. And then odd employment change gave a really strong indication for the Australian labor market, and we were able to take some quick buys off of that. This morning's data, however, was pretty mixed. When it comes to U.S. jobless claims, we had a big drop in jobless claims, which was a bit of a surprise given the weather situation and the strikes situation that has happened recently with the ports going on strike, which obviously that's been resolved, but that was still sort of expected to impact the labor market slightly. And then with the recent hurricanes, there was some speculation that that was going to increase jobless claims as well. And we've seen, at least today, that that is not the case, not yet at least. We had less people claiming that they were out of work than the markets were expecting. And because of that, we saw a big upside push in the dollar this morning. Now, this data came out at the same time as the Philly Fed and retail sales. Retail sales was mostly as expected. You can see here based on this lightning bolt. If we get a lightning bolt in this calendar, what it means is that the actual data has surprised all the forecasters. So this is the high end of the forecasting numbers, and these are the low end of the forecasting numbers. And then right here, you get the median, which is what you see on something like FOREX Factory. We didn't have any surprises outside of the bank ranges for retail sales. While it was hotter than the median forecast, it was still inside range, so we consider that as expected. Jobless claims, again, another one that surprised the markets from the median, but did not surprise based on the actual range figures. So maybe a little bit of an overreaction here out of the dollar this morning. Sort of my outlook anyways is that it's a bit of an overreaction. I certainly am not going to be selling the dollar at this level based on that idea of a overreaction. I think there's still some room to the upside for the doxy on this news. It's just a matter of how long this move is going to be sustained. Now, there's been a bit of a challenge to my outlook on the dollar as I've reanalyzed the fundamentals a bit. We have inflation heading to target. we have a strong labor market that has had a period of weakness over the last few months, but really the weakness in the labor market and inflation coming down is sort of just a renormalization of the economy. That's the way I'm starting to see it. And so I think over the next few weeks, depending on how things go with the election, I think we're going to start seeing the Goldilocks term pop up. It's it sort of left the conversation after this summer. I After again a reevaluation of everything that's going on a macro scale, I think the Feds maybe should have started cutting over the summer. Could have alleviated some of that softness hitting the labor market. But now that they've gone 50, now that they've gone 50 basis points, and we have the holiday season coming up, and we have the election coming up, I'm seeing a bit of a tilt in the upside potential for the dollar. I don't quite know if the Feds are going to continue to cut as maybe aggressively as we think, meaning the markets are pricing in 25 basis points for the next one. Let's go look at where the Fed Watch tool is showing us the rates are going. So 25 basis point cut for the next meeting in November. Beyond that, we're looking at an additional 25 basis point cuts. Let's go to about middle of next year. Markets are projecting mid to upper threes on the interest rates. I don't know if I'm super confident in this outlook. And the reason being, too much cuts over the next 6 months, 6 to 9 months, I think could present a potential inflationary issue again. And so I see a lot of kicking the can down the road over the next 6 months. I see a lot of we like where monetary policy is at. We don't want to create any upside inflation risk. And all of this sort of outlook, this longer term outlook, we are theoretically moving into a rate cutting cycle. If you look back at 2021 to basically the end of 2023, we were in a rate hike cycle. I don't know if I'm buying in as much as I thought I was. I don't know if I'm buying into the rate cut cycle anymore. It seems like a great idea. Sure, on the surface, you have inflation coming down, you have a strong labor market. Why not ease monetary policy? But there's also a case for maintaining a relatively restrictive monetary policy if we have an economy that is still growing. And just take a look at the S&P. We are incredibly robust on the S&P. Why would we be cutting rates? The economy is still strong. So you have a 4.75 rate, but the economy is still going strong. So that's sort of there's some other levels to this problem too. We have corporate profits are up, and with corporate profits being up, we shouldn't theoretically see any job cuts happening, because corporations aren't going to cut jobs when they're increasing profits. They're going to reinvest profits back into their business. And a big part of that is going to be, I think, continued labor market strength. So you have corporate profits up. A big indication of a recession is job losses. But if corporate profits are up and they're not cutting jobs, we shouldn't see job losses, which means we won't necessarily see a recession, which points us back to, why would we be easing monetary policy if we still have a really strong economy given where interest rates are at currently. So all of that to say, I think once we get past the election, there's going to be some more clarity. I think once we get past the holiday season and we move into Q1 of next year, there should be some more clarity on where we're going to be headed with monetary policy. I sort of see, I can foresee a hold of rates in this 4 range. If it goes drastically lower than that, I think it's going to take a massive shift in corporate earnings and the job market. I don't know that inflation is going to, I don't know if we're going to dip into a disinflationary sort of realm and that be a catalyst for cutting. I think it's going to come down to the labor market, which is ultimately going to come down to corporate earnings. And so far with companies like NVIDIA and Meta and Apple and all these companies doing the AI race right now, it's similar to what I know. I was obviously a child when this was happening, but it's similar to what I know about the dot-com boom in the early 2000s. We have robust tech growth. We have, a really solid overall economy. We have a strong labor market. There's no reason to cut rates. There's no reason to start easing monetary policy because there's no weakness, right? So the typical dovish move out of any central bank is in response to the typical cut rates, make monetary policy easy is due to an economy that's slow. It's due to an economy that's super cool, and we're just not seeing that so far. So dollar projections for me, they're tough, but I do see a lot more potential for the upside than I was originally thinking over the last couple weeks. With that being said, I'm totally on board with the way that we scalp, which is red folder scalping. I'm on board with taking the dollar either way. If we get bad data, I'm scalping the dollar down. If we get good data, I'm scalping the dollar up. This week, we haven't had much as far as dollar data. We had retail sales today, which we didn't necessarily. I took a trade off of S&P 500 this morning, but it had nothing to do with retail sales or jobless claims. It was a purely technical trade based on a overstretched ES tapping into these highs, these all-time highs, and giving me a nice little rejection formation. Right in here. You see this big push up, price fell, big push up again, 9:30 volume comes in. I got in a quick sell here and jumped out here. This was purely positioning, purely technicals, no real reason fundamentally to start selling the S&P 500. So we didn't trade retail sales, but we did trade Australian jobs last night, which was a great trade. The only thing I don't like about this trade is that I did not hold it farther. But we saw a hot Australian dollar labor market or Australian labor market come into play. And so the way that we scalp, if we get the right data within 5 to 30 seconds, we're getting in. And I got in about just after the first 5-second candle. First 5-second candle pops up. Second 5 candle starts to form. I entered here and I got out real fast. And then I was sitting around, waiting around for about an hour afterwards to see if price would come back into this area to test this little wick range here. Didn't end up happening until early this morning, around midnight. So I was not involved in this trade at all. This buyback up here. What else did we have? We had pound data, pound CPI data. Let's review how that came out real quick. Downside surprise for the pound. So downside surprise on the pound. This was a real easy trade. This dropped Wednesday morning at 2 a.m. I would have loved to have gotten in similar to the way I got in on odd here on this candle, and I would have been out within 5 to 10 seconds, but I missed this entry. So I waited around a little bit. Price tapped into here, saw this little bit of rejection, fell down, tried to push up, rejected again, tried to push up, started rejecting. So my position was in here. Don't quite have this marked up properly. Again, a real quick trade. This was about a 1 to 3, which was nice. And my target was based on structure. So where is this line at 103, 1.30? I was off of bad data, just targeting this major support here at 1.30 and got out. Real simple. So the way that we prep for this, trade triggers, pound CPI. I have my figures here. I messed up the graphic with this, but basically, if we see the core, regular, and services come out above the expected range, then I'll be looking to buy. And if we saw the vice versa of that, which again, I messed up here, but I go live and walk through all this, but this should have been less than, these should have all been less than symbols. If we see the CPI figures come out less than expected, there's that recalibration effect. So prices got to recalibrate, and we want to jump in as prices recalibrating real quick in, out. And that's exactly what we got. We got this bearish surprise out of GBP CPI and jumped in on quick sells. So other than odd employment, which again, we got a hot odd employment and a cool pound CPI, other than those two pieces of data this week, really has not been a super busy week for us. Now, next week, I believe we have one of my favorite pieces of economic data. Not my favorite pieces of economic data, but my overall favorite day, I should say. This day, Thursday, October 24th, when we get the Euro PMIs between the French and German, and then we follow up with pound flash PMIs, and then we follow up with USD PMIs. This is one of my favorite days every single month because it is historically given us the most frequent tradable opportunities. So we will be paying very close attention on Thursday to what is coming out of the Eurozone, the pound, and the US dollar. Then we'll trade CAD retail sales. And we're going to watch the BOC press conference and interest rate decision, but that's about it. So we actually don't trade next week until Wednesday. And then Wednesday and Thursday is going to be about a 24-hour, really just early New York session on Wednesday, a London session and New York session on Thursday, and then CAD retail sales on Friday. So another kind of quiet week. A really big day on Thursday, but other than that, not much for next week. And then before you know it, we are quickly approaching, we have NFP, and the week after that, we're in election season. So, or election week. A lot of excitement coming to the market for that. I think once the election is past us and we know who the president is going to be, it should be rather interesting to see how the markets react to that. I think there's going to likely be a quick adjustment. Once the president is elected, whether it's Kamala or it's Trump, it's going to be a relatively, within, I think, 2 weeks, the markets should settle into their adjustments based on who the president is going to be. That is all I have to cover. If you guys have any questions, feel free to drop them in the chat and I will go over basically anything you guys have for me. I'll give you guys a couple minutes. Oh, Kwame said NAS 100. If you're looking at a longer term, if you're looking at a longer term view for NAS and S&P 500, I mean, it's, we're still in the everything rally. And there's nothing that's happening that is insinuating to me that we're going to see any sort of sustained downside move out of S&P 500 or Nasdaq. Now, I would say if things escalate, war tensions geopolitically, obviously we should see some significant downside move on ES and Nasdaq. But as of now, it's kind of just like, what's going to stop it? What's going to stop the NQ from continuing to move up? What's going to stop the S&P 500 from continuing to move up? If nothing, then nothing, right? Geopolitical risk, I think, are the biggest sort of risk factor for continued upside in the Nasdaq. With NVIDIA, with the race for AI, again, this is similar. This is a very similar pattern, I think, to the .com era, the early .com era. We are seeing AI start to integrate itself into every level of the market, from the enterprise level at Microsoft and the other big tech companies to the consumer level, where people are just playing around with AI, and even small businesses utilizing AI in their everyday work. That sort of new technology taking hold and sort of becoming a new era of a life on the internet, and the major companies sort of in that race. Everybody's in that race right now. Every single major tech company is racing for AI. And with that sort of focus from major corporations, that level of focus on this specific type of technology, I don't see tech stocks suffering. Again, caveated by potential geopolitical risk, obviously. So it does make targets hard. I would say, as of right now, obvious technical targets are going to be previous highs, and then beyond that, it's kind of like anybody's ball game. As we're moving into these areas here in early 2024. Where do you start targeting? Okay, well, an obvious major target could be 20,000. But the first major target was 19,000. So you could go up by increments of 21, 22, 23. I see a lot more potential for upside right now in the tech sector than I do downside. But we do have an interesting couple weeks coming up with the elections right around the corner, with the Israel and Hamas tensions still in the air. The markets have seemed to have kind of swallowed those pills a little bit, and you can see Nasdaq really hasn't even been affected too much by the recent Israel and Hamas stuff, because the most recent issue happened here on October 1st. Right as we were coming into October, we saw some geopolitical risk rising. I think ES may have reacted a little bit heavier. No, ES reacted just about the same. So the markets shrugged off a brand new resurgence of Israel and Hamas tensions at the beginning of the month. So that's going to really have to explode. Something massive is going to have to explode in order to factor in geopolitical downside. So yeah, I'm bullish on the market as of now. I don't want to say that there's, no downside potential, but as of this point in the game, I'm very bullish on this market. I am interested to see how the U.S. election is going to affect it, though. I think with the Trump tariffs coming into play, if he wins, that's my only kind of hindrance for my underlying bias of ES and Nasdaq upside, just general stock market upside. I think both of these presidents may present short-term complications for continued upside move in the stock market. So that's a risk, the geopolitical risk coming out of the Middle East. That could be a potential problem. I think both of those scenarios, while a struggle for the stock market, potential struggle for the stock market, I should say, should theoretically benefit the oil market. And by benefit, I mean should drive the price of oil up pretty significantly. So I'm seeing a bit of oil upside in my worst case scenario for the stock market, but no necessarily oil downside out of best case stock market upside. I think oil is obviously its own beast. However, with the Middle East tensions, I think the risk to the upside is higher than the risk to the downside. Now you can see oil was drastically different than the S&P and Nasdaq during the sort of the resurgence, the beginning of October resurgence of the Israel and Hamas conflicts. We saw a big push in oil. Now we've recovered, I want to say this is probably about 75% if we pull up a fib level and go measured move. Yeah, 76. So we've retraced to almost to the 76 level, which for me, I don't love to see almost 80% retracement of a move like that, as far as confidence that it will push back up to these levels anytime soon. I'd much prefer like a 50% equilibrium discount and then a push back up. Although, the case could be made that these are decent areas to start buying oil back up at. So let's see what else we can touch on. Gold, of course, is just doing gold things and pushing up to all-time highs and pushing past all-time highs, it would seem. 2,700. Again, with no real reason for gold to start to fall. So, we're still just in the everything rally phase of the market, I think. And the upside risk the downside risk for gold seeming to not necessarily be existent right now. The only thing I would say is I've seen some headlines coming out in the retail space, not retail trading, but sort of just the retail market of general population, where Costco is selling a bunch of gold right now. That makes me a little hesitant, because I'm like, okay, once the mainstream media gets a hold of some information like, oh, Costco is moving a ton of gold, everybody and their mom is buying gold. I'm like, everybody and their mom is buying gold as gold is at its most expensive. That doesn't bode well for me to want to get involved. I would actually much rather look for opportunities to sell gold. So that would be things that would theoretically push the dollar up. But again, I don't just want to sell gold based on its negative or inverse correlation to the dollar. I need some real solid supply and demand data to hit the market for me to want to do this. So, all right, my next focus moving into next week, like I said, my main focus is going to be Thursday's data with the flash PMIs, and Wednesday BOC. I am interested in trading that, but that is all I have for you guys. 73 said up to where? Are you talking about gold up to where? Because that is the question. That is if we knew that, that would be incredible. How do you target all-time highs? I think that's the biggest question everybody wants to know. I mean, where does this gold market go from here if it's continuing to go up before it comes down? And what would drag it down? What would bring gold down? Yeah, no problem, Jay. Happy to help. It's my approach is very interesting because I'm more of a scalper than I am. I really rarely take day trades or swing trades anymore. I am mostly a red folder scalping. So the way that I trade is oftentimes I'm only looking at some of these bigger pictures to give myself an idea of positioning going into data. For instance, like with something with the Australian dollar, we're stretched incredibly to the downside going into this labor market data. So when we got really strong labor market data and the market is incredibly down on these higher time frames, like this 4-hour big push to the downside, we're near some major 4-hour support, and then we get really strong labor market data that increases my confidence in my scalp. I go, okay, Australian dollars stretched to the downside. We got economic data that shows the Australian economy is actually a lot stronger than what's currently being priced in. There's going to be a recalibration. I want to be involved in this at least a little bit. And, that's basically the way that I trade, pretty much the only way that I trade anymore. There are times like this morning where I took a quick ES scalp to the downside, but I don't like to do that because then when I have to journal, I have to go my catalyst, no catalyst, and I hate writing no catalyst because it isn't my tightest edge. It's not my sharpest edge in trading. My sharpest edge that I have discovered and I have worked out for myself is scalping that recalibration. I'm a very fast. I can pull the trigger very quickly once I see the data, and I can pull the trigger very quickly once I see the profit. And I lock in profits. I was a part of the recalibration move, and then I wait for the next opportunity. It makes things a little slow sometimes. There are weeks at a time where I don't get a trade. And there are, but basically all of July and August and the beginning of September, minimal trades. I think I took a total of like 4 or 5 trades in 2 months, which is pretty hard when you're showing up for 25 events. I essentially show up for about 20 to 25 events every single month. And so, for most of the summer, there wasn't much to trade. Moving into later September and October, we've had really good opportunities, which has been awesome. But yeah. Let's see. Euro USD. So Euro USD is interesting. I brought this article up actually from FOREX Live. So their opinion, which I can get behind based on some of their points, is that the Euro Central Bank is behind the curve. So let's go to some of these. Let me highlight some of the things I thought were most important. Right here, Lagarde repeatedly highlighted downside risk to growth and even said that all the data is pointing in the same direction. So all the data is pointing to weakness out of the Euro economy. Okay, we're getting a weaker Euro economy. They should start cutting and making, taking the approach of a dovish stance in order to heat up their cooling economy, right? It's pretty simple when you think about it from all the data is pointing in one direction. We should start easing policy significantly. And they cut today, but there's nothing forward guidance wise out of the ECB that is telling the markets where they're going to go. All she kept saying is they're data dependent, highlighted data dependent. But all the data is pointing in one direction. So sort of some confliction coming out of the ECB. I'm, as my doxy bias is sort of shifting a little more bullish. That's contributing as well, but my overall euro bias is more downside out of euro, unless we see some significant changes out of their economic data moving forward, which I think is really what President Lagarde is trying to prepare the market for, is the potential surprises. But so far, all the data is pointing to a weaker euro economy, and the markets are pricing in. I kind of think the markets are anticipating that the ECB is going to be moving in a easing direction significantly for the foreseeable future. So euro USD downside is sort of my base case. But it is, it's also a matter of entries and where do you get in? How do you try to trade out of this? Are we going to see a little bit of relief here in the next couple of weeks as we approach US elections? If we do, and we come back up to this 1.10 level, I think this could be a good area to start looking to sell out of. If we continue to drop from here, I'm probably not going to be involved in this move. But again, it just depends on how next week's data drops. So on by next Thursday, I will be getting back involved with a euro trade. Until then, I'm not touching this. So next Thursday, we have the flash PMIs out of France and Germany. And once those drop, I will be I'll be scalping those. But yeah, my overall bias for euro USD is a bearish bias, but it's sort of caveated by economic data and data dependence coming out of the ECB. All right, guys, I'm not seeing any further questions, so I'm going to go ahead and call it. From all of us here at the A1 Trading Show, thank you, and we will see you again tomorrow.
Thank you for watching today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. We're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. You can fill out an application with the link in the description below. That's all for today. Trade safe, and we'll see you tomorrow.